Good afternoon, everyone. Welcome to the January edition of NDSU Extension Agribusiness's Agricultural Market Situation and Outlook webinar series. Kicking off a new year here in 2025. We do have a bit of a unique schedule just because a lot of us are traveling and have lots of commitments with it being winter meeting season. So we're going to kick off with Brian Parman, and then I have a recording from Frayne. Tim and Ron will then speak, and then we'll take questions at the end. And again, you can use either the chat feature or the Q&A feature to ask questions. But with that, I'll hand it over to Brian Parman, Ag Finance Specialist.
All right, so I'm going to go ahead and just do sort of to kick off the year macroeconomic update. There's been a lot kind of being discussed and a lot being said about what's going on in the macro economy. We have a new, and I put that in air quotes, administration coming in, which was an administration we had before, or at least the same chief executive. But, President-elect / former President Trump is going to have a new cabinet. He's going to have new heads of these various departments, like a new Treasury Secretary, among other things. So it's a little bit, while it is the same president that we had in the past, with this new group of people, comes in, we're probably going to have some changes, and I don't know how much of the previous 4 years we can then use to gauge what the next 4 years will look like. And I sent this article to some of the colleagues there, and I really liked this chart from that article about what's going forward. And I put the citation there at the bottom. And this is basically what business is kind of dealing with going forward. And what they basically stemmed from the article was, we're moving into this period of time where we have known unknowns. Basically, we know what the issues are, but we don't know what the likely outcome is, right? We don't know what's going to happen. If you know what the issues are, and you know how they're going to be handled and the likely outcomes, that'd be known knowns. And then the worst place to be, unknown unknowns. We don't know what these might be or what to do about them. That's a place you certainly don't want to find yourself. But basically saying, look, we know things like tariffs are being discussed in the future. We know sort of what some of the challenges are that the world's facing, but we don't know what the resolution is going to be. And so we have to prepare for that unknown. So shifting into as I said, macro talk, where we stand heading into 2025. The latest and greatest inflation report that came out from the BLS, headline inflation was up a little bit to 2.9% for the month of December 2024, and core inflation down about 0.1% to 3.2. Most of this headline inflation increase from the previous month is the rise or the decline in the negative in energy prices. Those energy prices have come up some compared to last month, increasing that headline inflation number. While at the same time, it's kind of the first decline that we've seen in core inflation, albeit a small one. And industry was expecting 3.3% again, turned out to be 3.2. And this is just kind of showing where inflation is right now versus where it was. That core inflation number at 3.2%, it's really just been stubbornly hanging around 3.3, 3.4, 3.2% since early last summer. I mean, that's where this has been. Headline inflation had dipped down into that 2.5, 2.6% category. But again, it's come up over the last several months from where it was. Now, it's obviously nowhere near the peaks that we saw before, but one of the things the Fed is monitoring, obviously, is they don't want to see inflation going up at all. They don't want to see these inflation numbers, especially several months in a row, which could certainly indicate a problem. And I like to put this, and I'm putting this in here because what a difference one report or a day makes. This was the market interest rate expectations pulled on the 12th of 2025. So not all that long ago, right? And about 30% of the market thinks that by the end of the year, the federal funds rate will be about where it is today, 4.25 to 4.5%. So in other words, on the 12th, 30% of the market thought there'd be no rate cuts. 40% of the market thought there'd be about a quarter of a point cut. So not much in this whole year, all the way into December. this year, this current year, and then a few, let's say 28% or more thought that there would be a cut of at least 0.5% or more this year. So the vast majority thinking there's either going to be no cut, or if a cut, just 25 basis points or 0.25%. So then I pulled the same chart on the 15th, okay, after some other reports came out, namely like PPI and some other things. And look how much this changed. Now all of a sudden, 16% thought that there'd be no rate cut. So I go back, it was 30, so half of them almost left. This was close to 40%. You go back to the last chart, and then it's 34, and then these numbers obviously grew. What that and why I showed that slide at the beginning about known unknowns, what this essentially is showing is that every piece of information, because people are just in markets and in the economy, whether it's the US economy or the global economy, are are struggling to make a forecast of the next 12 months. So every time a new report comes out, I mean, there are just big swings in expectations. And that's kind of indicative of uncertainty moving forward, that every report or every little bit of data has somewhat of an outsized impact on what people expect, because they're basically trying to fill in a lot of blanks that they have going forward. So here's the federal funds rate versus the 10-year yield versus the 30-year average interest rate. And what you see here going on is beginning in September, the federal funds rate started dropping and it fell 0.75% or 75 basis points since that September period. So there's been 3 separate rate cuts of 0.25 point since September. Well, what's happened with mortgage rates and the 10-year yields? Well, actually, mortgage rates have increased since that September period. They've increased all the way from around just over 6% to averaging around 7%. And the yield on 10-year treasuries has continued to climb as well. And so another thing I wanted to show then is how high is this interest rate that we're period that we're in right now. And I apologize in advance, this chart looks a bit busy, but I just wanted to show a few facts on where interest rates are versus an average. Okay, so here's the 30-year rate for interest rate, and this red line is the actual average during that same period of time since 1970. So the average mortgage rate or 30-year rate since 1970 is 7.72%. Okay, and the median is, and these are in weekly, so not yearly, but weekly mortgage rates, and the median about 7.35%. But when you look at this on the timeline, I kind of broke this out looking at the data. You see, you had 30 years of rates that were, a few years notwithstanding, higher than average. So from 1970 all the way to almost the year 2000, with a few periods in the 90s where it dipped below that. And then the last 25 years, the 30-year interest rate, mortgage rate has been below average, has been below that 7.72%, starting in about 2000, getting above it a little bit in 2024 there, or 2023, over that 7.5% mark. That was briefly, but that's kind of where we've sat. So it's almost as if we came out of a 30-year period of higher rates, where rates were much above this 7.5% threshold for a long period of time. And then another 25-year period where these rates have been just low and stayed low for a long period of time. So what the challenge with that is, if someone were to say, well, are rates at above or below average? Well, right now they're below average. I mean, they have been for over a decade, almost, 2 decades plus. But when you start making business decisions and folks start borrowing as if these rates are the way forward instead of these, it really changes the math on how much debt you can afford to take on and what the cost of borrowing is, et cetera, et cetera. And as a result, even though these rates on a historical timeline at 7.5% are not all that high compared to the 30-year period before, it's been a while since we've operated in that kind of environment, and there's probably going to be some serious adjustments that need to be made if we're moving from this 25-year period of what I'm calling the low rate era back into a higher rate era. That this and I'm not talking about getting up to 20% like in the 80s, but operating at 7.5%, 8% for a while. If you wonder how long that can be, sustained, you don't need to look any farther than this chart in history. And so I read an interesting article on one of the topic being how can the Fed be reducing the federal funds rate while interest rates continue to climb? How does something like that happen? And as I've said in many of my in-person talks that I've given, there's more that goes into setting the consumer and commercial interest rate besides what the Federal Reserve does with the federal funds rate. And what I mean is there's competition for buying up this debt with things like treasuries, with other corporate bonds and stuff like that, because when mortgages are taken out or packaged or whatever, that debt is often bought by investors or people in the markets. And so this was the headline of the article, why are interest rates rising when the Fed has been cutting them? And one of the things that's happened is there's renewed fears of rising inflation in the markets, whether it be because of threats of tariffs, whether it be because some of the data is showing, for instance, that headline inflation has increased slightly. Whatever the case may be, there are some indicators out there that inflation could pop back up and become a problem. Well, if inflation rises, it may not only slow the pace of the federal funds rate cuts, but they may also actually have to increase the federal funds rate down the road if inflation becomes a problem again or starts rising fast enough. And I don't have the slide in this particular presentation, but I show in history where that's actually happened, where rates were cut too soon, inflation increases, and the federal funds rate has to increase again, even higher than it did in the first place in order to get out in front of it. So what does that in a sense do? So let's use the 10-year note or 10-year treasuries as our baseline here because 30-year interest rates are tied very closely to this. So if people expect rates to increase in the future, for instance, the federal funds rate or whatever to increase in the future because of rising inflation, then the bond price of all existing bonds that carry, let's say, an interest rate on it or of 5%, we can't adjust the interest rate on the bond. The only thing that can be adjusted is the price you pay for the bond. So then the bond price must fall to get them all sold. The increase in the yield on bonds comes from if the price drops, then the yield increase, which forces returns on other long-term investments higher to forces them upward to compete with that. So in other words, if 10-year treasury yields are increasing because bond prices are falling, then if I'm selling new mortgages or something like that, mortgage-backed securities, those kind of things, to actually get them packaged and sold, so the banks aren't holding on to them, I have to offer them at a higher rate of return than I did because these bond yields are increasing. Which the only way I can do that, increase the interest rate on those, which increases the interest rate on the person borrowing the money. And so therefore, interest rates rise based on future expectations. People are thinking that inflation could come back around, which makes them believe that the Fed could increase the federal funds rate, which makes bond prices fall, which makes yields increase, which drives up interest rates. So that's not all encompassing, but it's an example and a reason why this can happen despite the fact that the Fed and what it basically says, interest rates are based on future expectations in a lot of ways, despite what's happening or has happened so far in the past. And so basically, there's a lot of unknowns headed into 2025 with respect to the macro economy, whether it comes to trade policy, potential anything changes going on with taxes, what's going on globally. There's some real weakness in some of the other countries economically, and so just a lot of uncertainty there. And so every time a piece of news drops or every time a new report comes out, there's just this big swing in expectations and behavior within the markets, causing a lot of this, I suppose you could say, volatility going there. So with that, that kind of concludes the kickoff to the 2025 Situation and Outlook series. I have to unfortunately step away. I'm in the process of overhauling and updating our Design Your Succession program, and it's a big job. So we're working on that right now. But if you have any questions, I encourage you to email me. You can see my email address, brian.parman@ndsu.edu. I'll try to answer your questions no matter what they want to be, what they might be. And so with that, I'll go ahead and turn this over to the next presenter.
Hi, I'm Frayne Olson, crop economist and marketing specialist with NDSU Extension. I'm sorry I can't be with you today. I am traveling and won't be able to attend the webinar live, but I did provide this recording, so try and give you an update on what's happening, in particular from the USDA reports. Here's my contact information. Again, as always, please feel free to try and reach out to me if you have any questions. I have my email on there. Probably the cell phone would be the best bet if you want to try and talk in person. So let's just dive right into it. On Friday, January 10th, USDA actually released, 4 significant reports. Now, the beginning of January, this happens every year. We have the January update for the WASDE, or the World Agricultural Supply and Demand Estimates. We have the annual production report, which is the final official numbers for production, as well as planted acreage, harvested acreage, and yields for all of the major crops we grow in the United States. Okay, so that's a big one because those are the final official numbers. We had the grain stocks report, which is on a quarterly basis. So every 3 months we do an inventory of what's grain is available within the supply chain. The report we got on the 10th was actually from the survey in December. And we also got the winter wheat and winter canola seedings reports. So the seeded acreage for both winter canola as well as winter wheat. I'll talk about the results in just a minute. I'm really only going to focus on the WASDE report, that World Agricultural Supply and Demand Estimates, and the annual production report. There really wasn't a lot of shock or surprises that were held within the grain stocks report or the winter wheat seedings report. They came in very, very close to what the trade was expecting. And so we really weren't the key pieces of information. But I do want to spend a little time going through the production report, the information held there, as well as the WASDE, because that's where the surprises were. That's where the shock value was. That's one of the reasons we got an increase in prices. Very quick update on Brazil and Argentine weather. Brazilian weather in the north has been pretty progressive. It's been pretty good. Brazil is just starting the beginning of their soybean harvest. They're less than 1% harvested as of now. There has been some showers coming through, so they're not making really quick, rapid progress on soybean harvest. We're seeing some harvest delays, but again, it's very, very early. Yield reports, we're not really getting anything out yet. It's a little bit too soon to see that. In the southern part of Brazil, they've needed a little bit more rain. They've been getting some of those rain showers. Not major concerns yet about crop condition ratings, but there is a little bit of uneasiness that they do need some rain showers, and then you're going to need some regular rain showers to be able to complete this crop, in particular as we get warmer into their summer months. Argentina, on the other hand, has been a little bit dry, not to a point where everybody's getting really worried and concerned yet, but there are some of the private analysts starting to take a little bit of the top end off of their corn and soybean crop. Now, my personal view is it's a little bit early to start taking too much of that off because the plants are in the middle of their vegetative development stages. They can handle a little bit of stress at this point to not have major yield damage yet. But again, we need to watch that very closely. There are some of the longer term forecasting models that are calling for Argentina to become a little bit hotter and drier as we move over the next several weeks. So it is something to keep your eyes on. I also want to make a few comments about kind of the U.S. trade and tariff policies. I'll do that at the very end. Just some observations about what might be coming now over the next couple of weeks as the new administration takes over the White House. So let's dive right in. This is the information from the production report. So these are the final official numbers for production and harvested area and yields for both corn and soybeans. As always, the highlighted blue line on top is the average trade estimates. So that's what the forecasters and analysts that look at this stuff on a daily basis, that's what they were expecting to see out of the USDA report. Towards the bottom, the black bolden line is the numbers that we got out of the November 8th production report. That was the last time we got an update on yield forecasts and harvested acres. And I just want to caution everybody, one of the, kind of the surprises that came was that the USDA cut those numbers more than expected. So again, if you compare the blue line on top with the red row on the very bottom, which is the numbers we got on Friday, this was a bigger cut in harvested acreage and, more importantly, in yields than the trade was expecting. So that was the surprise, and that was the shock value for both corn and soybeans. Now, people are asking me, why did that happen? The very short answer is some of that later harvested corn and beans didn't perform as well as they had expected. So again, November 8th was the last time we got an official update, which really means the data was collected at the very end of October. Now, we did make good harvest progress, but when USDA surveys farmers and tries to get the information from that October, November time period, they're really focusing very hard on the Iowa, Illinois, that core Corn Belt regions, okay? And so they do a much better job of surveying those core heartland areas than they do kind of on that outside edge or the periphery, kind of what I call the transition zones. And from what we can tell, what actually happened is the Eastern Corn Belt in particular, when you get into, for example, Ohio, parts of Kentucky, even parts of Indiana, that Eastern Corn Belt, the tail end of the crop, the last acres harvested, didn't perform as well. And that started bringing down the averages. And so we had some of those production zones on the outer fringes of the Corn Belt really underperforming, and that brought the average down for the nation. So the big surprise was really the production numbers. So let's look at the blue on top. That would be this number for the 15.1 billion bushels of corn production was what we expected. And we actually got about 14.8, almost 14.9. Now that's a pretty significant cut. And that did put a nice lift into the corn market. Very similar thing, most of that came again from yields. If you notice that the yield drop, almost 4 bushels, 3.5 to 4 bushels. On the production side for soybeans, again, there was a significant drop, not as much as it was for corn, but it was significant. Okay, and that was also then you have both corn and soybeans getting some surprises in the same direction, and we got a lot of trading activity. And again, that put a nice little lift into both the corn and the soybean market. So how did that translate into ending stocks? And again, the ending stocks, as I said for a while now, is really what sets kind of that psychological boundaries. I'm saying, well, if this is what we expect to happen, what kind of prices would we need to see in the marketplace? Are we doing a good enough job of rationing our corn and soybean consumption? Now, there was really no surprises within the wheat numbers because we essentially got the final official wheat numbers in September. So the numbers, what the trade was expecting versus what actually came out in the report were basically rounding error, very, very tiny differences. Again, the corn numbers, when we look at, because we had lower production, USDA really didn't make a lot of substantial changes in their consumption numbers. And so a lot of that got taken out of the bottom line. So we took our ending stocks for corn down for this time of year, actually pretty significantly. Normally, we don't see that much of a change in this report. The same thing for soybeans. Okay, we started with a higher number. The traders were expecting that number to be trimmed a little bit. It got trimmed a lot more than expected. Now, one of the things I do want to caution you, especially on the corn and soybean ending stocks, they were tighter, but they're not tight. Okay, so we started out with some pretty big numbers, and we had some pretty big numbers in our head before this all came in. They're a little bit smaller than we had expected, but they're still pretty sizable numbers. So nobody's really worried about running out of corn or running out of soybeans. So we did get a bump, we did get a lift in the markets, which is good. It's supportive, but I don't know personally if it's enough to really generate that long, nice rally that everybody's hoping for and looking for. We still have plenty of corn and beans around. So let's look at what the price response was. And I want to primarily focus on the right-hand side. This is the March corn futures. So this is the nearby futures. This is for old crop. So if you deliver to the elevator or to an ethanol plant today, this would be the futures market price that the dealers or the marketers are using. This is as of yesterday evening. Actually, the close of business yesterday. So you notice on the far right-hand side, we did get a nice little rally in the corn market. We're trading at about that 460 number. We're at about 478 is where we closed yesterday. You know, that's a pretty nice little bump. Now, is it enough to really give us a big rally? Probably not. It seems like we're into that 479, 480 number, and it looks like we're starting to kind of top out a bit. So we're going to need some additional news in the corn market to try and keep this rally or this upward movement running. And again, part of it, as you've noticed, we've talked about this before, this general increasing or this general strengthening in the corn market, even though it's been very slow and kind of a grind, is primarily because we've had really good exports. I mean, better exports than last year. Okay, and so now the question with the higher prices, will that export pace hang in there? Will it continue? Now, when we shift to new crop corn, so this would be December 2025. So I'm getting some questions, should we be pricing some new crop corn at these levels? So I want to go back and forth here a little bit. So as of yesterday, we closed at about 457 versus old crop is at 479. Let's call it 479. So we have, you know, about a 20-cent spread between old crop and new crop. Now, if you look at the new crop charts, we have some similar resistance levels or support levels. They're just at, you know, from a charting standpoint, they look similar, but they're at different pricing levels. So in my view, I think it's a little bit, this wasn't enough to really put a big boost into new crop corn. Again, it was supportive. I think it provided some additional strength in the marketplace, but we're really going to have to work pretty hard, I think, to get through that 460 number on new crop corn. So the question is, should I start pricing now? I mean, if you're comfortable pricing in this range, I wouldn't discourage you from doing that. Okay. The other part of it, though, is I wouldn't be terribly aggressive. Is this something that I'm really going to get excited about? Probably not. Now, I do want to caution you, and I'll talk about it at the very end. There are some downside risks that we do have to be concerned about. So part of this is what kind of a risk appetite you have, and how long are you willing to ride that risk roller coaster, if you will, as we move forward in time. Shifting to soybeans, again, we did get a nice pop or rally in the soybean market. We're at about 10.15-ish. Before the report, we're about 10.65 right now, give or take a little bit. So we had probably a 30 to 40 cent rally in the soybean market, which is very good. I certainly would be trying to use these pricing opportunities to get rid of some old crop soybeans if you still have some left. Okay, now, is that enough to really sustain a longer rally? Probably not, given the fact that we still have some pretty big expectations for a big crop, soybean crop coming out of Brazil, but also a very substantial crop coming out of Argentina. For new crop, again, looking at new crop, we did get a nice little bump. We got up to just about that 1060 number, which was the previous high we saw in November. Again, this would be for new crop soybeans, not old crop. For new crop soybeans, again, this one's a little harder. It's the question is, what kind of a basis would you get if you were to forward contract for 25 delivery, for harvest of 25 delivery? Is that probably $9.60 to $10 range? Is that going to be enough? Given what I see right now and some potential downside risk in the soybean market, I would consider doing a little bit of forward pricing on soybeans. I know there's a lot of time left, but there's some really big issues that we're going to have to face here shortly that I think are going to put a lot of kind of pressure on the soybean market. So to do some new crop, I think would be an okay task. Not doing a lot, but a little bit at this stage of the game. Old crop, again, I think this is an opportunity to get some more old crop soybeans sold. Looking at spring wheat, I just wanted to show you the old crop wheat prices. Again, we've been in this trading range for basically a month or month and a half. There wasn't anything in the report that was really going to give us that lift in the marketplace. So some final comments on about kind of this trade and import, in particular tariff issues and tariff concerns. Again, with the new administration coming in, President Trump has been very adamant and vocal about using tariffs and using them very broadly and widely. And I know there's a lot of people within agriculture concerned about that. Now, there's still tariffs have been around for a long time. They're a tool that's used in the toolbox to try and, from a policy standpoint, to try and get some changes made, especially when we're looking at country to country kind of relations. Or if there's a particular product or particular service that has some concerns, or we're trying to protect like our domestic markets, if you will. Now, there's many different ways to use tariffs. And so I don't know what's going to happen. Nobody really does. There are a few things that I'm going to be watching very closely as these tariffs, if they come, how they're announced, how they're rolled out, what is this going to look like? The first, which in my opinion is probably the most important, is this going to be a broad-based tariffs? We're going to say, all right, we're going to put an X% tariff on all products coming from China or all products coming from Mexico. Okay, those are very broad statements. Those would have pretty significant economic impact, not only to agriculture, but also to the general economy. Versus doing something like very targeted, where you're saying we're going to put a tariff on these specific items or these specific items from a specific country. For example, if someone would say, well, we're going to put an import tariff on the used cooking oil coming from China. That's very surgical. That would obviously benefit U.S. soybean oil prices. So it's something agriculture would look at and say, well, this could be positive. But it's also something that would not necessarily have big, broad ramifications for the greater economy. So the targeted kind of things is typically how tariffs have been used, although President Trump has been talking about using these very broad-based tariffs as another tool. So we'll have to wait to see. So that the scope, if you will, of these tariffs are going to have a huge impact. The another one is obviously, what is this initial tariff levels? If we're looking at relatively small or incremental kind of tariffs at 5 or 10%, those are things that will get people's attention, obviously influence trade flows, but it may not necessarily add a lot of inflationary pressure into the U.S. economy, and it may not cause big shocks or big changes within our commodity markets, in particular with agriculture. Another would be tariff rates. Are they incrementally increased over time? Is this all right, we're going to put 25% tariff on, we're going to leave it and see what happens? Or are we going to start with this 5 or 10% and then over time start increasing those levels if we don't have the change of behavior that we're hoping for? Another one, of course, is this timeline, and those are closely related, right? If this is going to be, we're going to announce the tariffs today, but they won't be implemented for another 6 months. That obviously gives traders as well as companies and actually trade negotiators time to be able to sit down and try and discuss this to see if we can prevent those kinds of tariffs from actually being implemented. Okay, so just because there's an announcement there's a tariff doesn't mean that they're going to be implemented automatically or that they're going to go into effect automatically. So there might be a timing difference where companies and negotiators will be able to work something out, or at least figure out what the plan B looks like. And of course, what is the response from the other countries? So if we put a tariff on China, what is China's response going to be? If we put a tariff on Mexico or Canada, what is their response going to be? If we put a tariff on steel and aluminum like we did last time, what is the response from Europe going to be? Okay, so there's a lot of dynamics here that we really don't know. So what is the response? And in agriculture, that's really what we're concerned about, is not necessarily what we do, but what is the response from our trading partners going to be? And the final thing that I'm really looking for, especially when it comes to negotiating or looking at some kind of negotiated or agreement that would remove or reduce those tariffs, is what is the end game, or what is the objective of these tariff policies? And again, right now, I haven't heard anything specific. There have been some discussions about that, but we will not know what the specific end game or objectives are for quite some time. So unfortunately, we're just going to have to sit back. We're going to have to try and pay attention to what's happening. I know that there's going to be a lot of volatility in the marketplace, both upwards and downwards. I think the concern for most farmers is the downward pressure on prices, not necessarily potential upward pressure. But that is possible depending upon how all these different variables and all these different things that could play out. So I'm going to stop sharing. So with that, I appreciate your patience and the time that you've been here and listening. Again, if you have any questions or have anything follow on that you want to discuss, I'd be happy to do that. Thank you very much.
Good afternoon, everybody. Tim Petrie here, Extension Livestock Marketing Economist. Just going to kind of give you a quick update on the cattle market. Been giving a lot of meetings and Frayne and I as well, so I know what he was going to talk about is the last report out on Friday that was somewhat, at least to start with, bullish on the market. But anyway, I've been starting all my meetings saying the temperature's cold, but the cattle market is hot. But today I can't even say that the temperature is cold because it's nice out. But I guess by the weekend I'll be able to say that again. So let's move along here. Starting out on top with fed cattle futures that are at all-time record high levels. Again, my charts are all the same here with the green 2022, purple 23, the blue, light blue 24, and then red is 25. And so we're just starting off the year at 2025 at record high levels there of, last week, $203, which is an all-time weekly record high. And the futures are, up there too, above last year and at very high levels. So, first of all, we do have short supplies because 2024 was the sixth straight year of a declining beef cow herd. Although I've talked to you about it before, it was kind of interesting. Last year in 2024, we had the same beef production that we had in 2023 because of the big increase in carcass weights of steers and heifers, enough to amount to about the equivalent of another million head of cattle. But we're still relatively low on supplies, what's driving. But the other thing that's really helping us out and why the markets are so gangbuster is the demand for beef just continues to be very good. And so we go down to the bottom chart is the boxed beef cutout. That's what every day, or these are weekly, but I'll just talk about the daily here in a minute. This is what the packers can sell the meat for. Either goes into the domestic channels, which are the supermarkets or the food service, and then also exports. And they're all of those are booming. Food service is booming, and demand at the retail stores, and exports have outpaced the prediction for last year. Exports ended up about the same last year as the year before at higher prices, which means export demand was good, and our demand was good here. Last week, you see the chart on the bottom really parallels the chart on the top. Last week, we were record high on the cutout at 329. It's going to be higher this week. This morning's cutout value was 333. Yesterday was 334. So the previous high back there in July of last year was at 330. The all-time high was the year before there in 2023, again about the same time when the big grilling season starts, up there at 340. But we're going to be higher again this week, up to probably 334, or so. And so beef is moving. Prices are good. The packers can sell it for more, so then they pay more for fed cattle. And when they pay more for fed cattle, and the futures are part of that, then feedlots can pay more for feeder cattle. And again, we have a short supply all the way along. So that's what's going on. It's both supply and demand related, and demand is really good, and supply at least is relatively short. I realize that, it was last year was about the same as the previous year. So that's what's sparking the market. And so then we go to our 550 weight calves in the same way. They're following along. We've been cyclically up year after year after year. Go to the red line on the upper left-hand side. The average price in North Dakota of the markets that reported, it was $345. Again, that's higher than any time last year, and last year throughout the year we were at record high levels again. We've got shorter supplies there, but feed prices are relatively low. They have sparked here in the last couple 3 weeks or so, or month, I guess, on corn a little bit, but still relatively low. So a good demand for the shorter supply of feeder cattle that we have, and just if you're selling, at least really good prices. On the other hand, if you're a summer grazer and you want to buy calves to put on pasture this summer, you're going to have to pay all-time record high prices for them, and we'll have to do a budget on them and see what happens. And if you do that, since these are the highest price going into the market, I would certainly kind of look at some price risk management. There's an old saying in the cattle industry: when the supply and demand fundamentals are good, they're all good, and when they're bad, they're all bad. And right now they are simply all good. And so if you're selling, that is a good thing. Feeder cattle, heavier weight feeder cattle, the same way, at record high levels there. The last week, 294 on them. And so, we are running quite a positive basis. Now you see those red squares there are the futures market for this year, throughout the year, and they are lowering the cash price here, but we're running a $10 to $12 for the 758 weight steers above the futures, simply because the shorter supplies we get, the more the feedlots have to come further and buy up on them. And last week, I talked about issues there. We down in the south, and I'll mention more about that a little bit. The Mexican border is closed to calves, so the feedlots are short of getting cattle down there. And then up here, we're sending more to Canada than we have the last couple of years, so that even shortened the supply. So a really good demand for these heavier weight yearling cattle. And then move along to cow prices. And again, they've been cyclical higher and higher. Last year they went really higher than 2023, because we really dropped off beef cow slaughter because the weather improved and so on, and we had fewer of them, but the weather improved. Now by the end of the year, in the fall, it did get dry in a lot of places in western North Dakota and down into South Dakota, but the southern plains has gotten a lot of rain, and the Appalachian states and so on. So cow prices follow that general seasonal pattern, that they go up this time of the year, and they're already starting to do that. And I simply expect that to continue unless a major drought sets in all over. And just one other comment, we're down there at about 115 now on these 85 to 90% lean cows, but these are the series I use. North Dakota does not report cow prices, so I use a South Dakota, Montana average. And these are the thinner, these are broken mouth cows that have had a calf on them all year. And so they are thin and would be towards the low of the market. Up in the upper right-hand corner is a market that a North Dakota market for cows earlier in the week. And I know that there are cows bringing in the 130s or 40s, or maybe even topping out there at 152. So, those are the higher yielding younger cows that, maybe are open or lost a calf or something like that. And so a wide range in prices for cull cows, just like they are for calves. And my chart shows the bottom end. But on the other hand, the trend is the same, and we're expecting to follow that normal seasonal pattern for these cows to increase seasonally and be at higher levels than last year because of the fewer supply we have, like the other market classes. Just want to then mention to you that we're waiting anxiously. The new cattle inventory report will be out in 2 weeks on Friday, January 31st, and we're all greatly anticipating that. I just show you the numbers here from a year ago report that came out. Sometimes USDA, most of the time, puts out a July cattle inventory report, as I've talked to you about before and shown in the upper right-hand corner, that was not released this year. And so we're still back at a year ago numbers, wondering, and the question mark there, what's going to happen this year. So last year, again, all the numbers were down because our cow herd was going down. Again, our cow herd started going down in 2019. and I'm sure it went down again this year. But when we're looking at how much, I don't think the decline was as much this past year because we had better moisture conditions, particularly in the south. So everything was red down there last year, meaning lower numbers than in 2023, except cattle on feed, which was higher. And again, we've talked about that before. Why cattle on feed was higher is because feedlots kept cattle longer to put more weight on them with the higher carcass weights. And we had the same beef production last year in 2024 as we had the previous year because of these heavy cattle. So that was the case. This year, and USDA sometimes does go back and they, with their checks and balances and change a little bit what the 2024 numbers might be. So that's another thing we're looking to see. But just assuming they are the same there, I would expect beef cow numbers, if you go the third category down, total cattle, all cows, and then beef cows, there were at 28.22 million last year, that number would likely be this year about 28 million, which would be down 1%. And I think a lot of the categories would then be down probably maybe 1% if they don't adjust them. The one category that might be up are beef replacement heifers. And there are two categories. There's the total beef replacement heifers, but then those expected to calve. And I would think that the ones expected to calve would not be up much, but there is interest in some herd restocking, and I think there's a lot of heifer calves now. This would be last spring's calf crop that now would be 800 pounders or whatever that could be bred this summer. That would be the other category from expected calf. And I think that category likely will be up. That doesn't mean that they're really will go in with a bull this summer. And it all depends on what the moisture conditions are this summer. So again, on our next webinar, I'll have these same numbers updated and be interesting to see how things pan out. The other thing I want to talk about, and I mentioned this last time, that because of the old screw worm situation away in southern Mexico down by Guatemala, actually there's a Guatemalan cow that came in there. Our border is closed now to Mexican cattle. And as you see in the chart above, we dropped off from doing 40,000 usually this time of the year to nothing. But the main thing I want to comment on here, and I've been before this even happened, I've been in my meetings been saying, we're at high levels now and the market is volatile, but we have all these bloggers and social media and so on, and somebody says something on social media and pretty soon everybody believes it, and that isn't true. So we have to be careful there. And the same thing happened with this screw worm issue back on January 7th in the middle there, and I didn't want to disclose the source, but it came out the Mexican border is expected to be open to feeder cattle the week of January 20th, which was next week. Sources say, well, who are those sources? When that came out, I called up APHIS and they said, no, we aren't, the border isn't going to open. It isn't up, but somebody says something, it blows up, goes all over. Everybody believes it because it's on the internet, and that isn't the case. So down below then, you see that came out. All those rumors and everything. And so on January 8th, the futures market falls $3 there. It was a 268, went down to 265, but quickly recovered from that. So again, that's just the age we're in with social media and all this, and I guess we have to live with it. But when somebody says sources say, be careful, because who is the source? Actually, what happened is that APHIS said that they would try to start opening the border possibly January 20th for horses only, not for feeder cattle. And so then that gets, somebody says, well, they're opening the border, and pretty soon it's opening the border for feeder cattle. And that is absolutely not true, but it gets bombarded all over the place. So just a caution there. The border will open to feeder cattle sometime. I was just on a conference call with several USDA agencies and a couple of my counterparts on Tuesday, and they are going to open up the border, but it's going to be a much more rigid protocol than we have been doing of petting them and checking them and some holding. So when the border does open up, we aren't going to get bombarded all of some week with 200,000 cattle or anything like that. It'll be a slow process. It is going to open. unless they find more problems down there, and the likelihood of that is not great because we've been doing mitigation efforts for many, many years. APHIS raises sterile male flies here, and we keep dropping them off throughout Mexico to keep the population down. So the chance of finding more probably are not good, but they're erring on the side of caution. So with that, I got to quit sharing, and we'll turn it over to Ron.
My name is Ron Haugen. Most of you know me. I'm with Extension and Farm Management. And we have our new publication out that Frayne and Tim and I work on for our planning prices. We try to project planning prices for this coming year and then also into the future, which is a little more hard to do, of course, predicting into the future. And this is what we came up with. And this is what we give to FSA, and other people use this information. Our best guess on what it will be, it's who really knows how things will end up, but it's a publication that shows this, and this is our projections for the coming year. Wheat coming in at 6.25, corn at 4, and soybeans have a big drop at 9.50. And depending on tariffs, who knows what will happen with especially the soybean price. That's the big question mark. Okay. So the livestock is also part of this calculation. And Tim was talking about the record highs, and it's unbelievably going up here. So this is what we're projecting for livestock and milk as well. Also, we have hogs and sheep as well. And those are the projections for this coming 2025 year. And this is all laid out in the publication. I encourage you to go get it. It's not posted on our website quite yet. There's a process that we need to go through, but it's hot off the press. There will be some printed ones that can be available too, or you can go on the internet and print it out for yourself. It looks like this. It's called Plotting a Course, Planning Prices for 2025. Okay, and here in the middle of the publication, it shows all the various prices, and it also shows them projected out into 2030, which is a real guess, but that's what we have a methodology that we try follow, and we get help from FAPRI, which is the Food and Policy Institute in Missouri, and that's all they do is try to project prices. So, and then we use coefficients to compare them to the North Dakota relationships and go from there. Here's a link, and this may get you to that publication. I'm not sure if it's hooked up yet, but everything is getting real close to getting posted. I also want to talk about crop budgets, being to have a little time here. Of course, we do crop budgets for the 9 different regions throughout the state. They all have different things. It's a lot of times shows that it doesn't pay to grow wheat in the valley, but it does pay to grow wheat in the north central because of the land cost in the valley. And we use the rates and the prices for the various regions to come up with we do about 15 to 20 different crops in each region. So there's a lot of crunching to do, and we're in the process of doing that right now. And I wanted to give you a little heads up on what we're gonna get here. Fuel is down from last year, and that isn't a major expense, but it's good that it's down. It'll help the expenses. It's down almost 90 cents from a year ago. Fertilizer's pretty much flat. Fertilizer application rates though. The soil fertility, I just got information from AgVice, so we're plugging that into our formulas. And the soil fertility is down throughout the state. We had a lot of rain last spring that leached nitrogen out, and the crop was actually very good, and it sucked a lot of nitrogen out of the ground. So you're going to have to apply more. So even though the fertilizer is flat, your fertilizer bill may be a little higher, okay? Most of the seed is pretty much flat or maybe a little less, especially like for wheat and barley when the market price is down and you're using bin run seed. It's pretty, if you do, it's going to be a little less. Chemicals also are fairly flat, But now, of course, we cannot use dicamba on soybeans. So the soybean chemical budget may change a little bit. You might have to have maybe another pass with Liberty or something else instead of using dicamba. So some things will change there in the soybean chemical budget. Interest rate is down. Last year we used 8% for our operating, and now we're going to put in 7.5%. Insurance premiums are down because the market prices are down, and that's kind of dependent on that. And as of course we all know, it seems like machinery costs and repairs, they never go down; they're always going up. And land rent is flat, maybe up a tick, but I could say it's generally flat. And the first runs I've been doing with this, I don't have all the data entered, but man, there's going to be some negative budgets here, in certain regions and certain crops. I mean, it'd be a good year to skip farming, I think, on some of these crops. So anyway, that's what we're looking at, and we hope to have this. We'll hope to have the Excel files out on our website at the end of the month, and then always takes. We have to go through the process of getting the PDF files, and that usually takes a little longer. But we usually can get the Excel files where you can we have our numbers in there, and you can put in your own numbers and try and estimate your own budget, because everyone's situation is different. These crop budgets are just an estimate. So with that, I will entertain any questions, and I guess it's just Tim and I left here. And so if you have questions regarding anything that we did, just put it in the chat box or the Q&A, and we will see if we can answer that. I don't see any questions at this point.
USDA payments for farms, for crop
Yeah,
farms.
there's going to be that assistance payment that's out, and that's in the process. And then also there is a disaster payment for I guess it's called, I think the title is wildfires, but they really don't have any information on that yet. It probably will be run like the ERP like before, where you would get a bump up if you collected insurance, and if you didn't collect any crop insurance, you'd go through another procedure. I see we do have a couple questions here. I guess one of these is for the website for the livestock projections are this publication, that one I gave you. Okay, that has both the crop and the livestock. That's what you're asking about. And then I'm not sure about this one. You probably can take those last two questions.
Yeah, I'm not getting it here.
Oh, you aren't getting it? It's in the Q&A box.
Oh, Q&A. Okay, let me see.
What's the website for livestock projections?
Okay, it's that same. It's in that plotting the course. If you Google plotting the course, all the crop and livestock price projections are in that same publication.
Right, but it's not posted quite yet, though. So, so if if the old one pops up, the other one will be there in a day or so.
Okay, then the other question is, what happens with cattle prices up? What happens with pasture rent and value? And the answer to that is, when crop prices are up, what happens to cash rent? The same thing is going to happen to pasture rent. It's going to go up. That's my quick answer.
The question: where do you find what the crop disaster payment per acre is? Oh, I don't have that handy. I could bring it up for you. It's published in several places. Go on the USDA website and try to see if you can do a search on that. I can't recall it off the top of my head, but I think it's roughly. I don't want to say. I guess I thought it was $40 an acre for.
No, that's for that other the disaster is the ERP, isn't it? And that isn't really known.
Oh, okay. Oh, yeah. Sorry, I read that wrong. Yeah, that was for the assistance part. Yeah. No, we don't know what that is yet. They haven't even come
disaster
up with that
payments.
yet.
They don't know, and it won't that be automatic, just based off from crop insurance?
Based on your crop insurance proceeds.
But what's known is,
but we don't know what percentage they're going to pay, because I think they're going to wait till everybody applies, and they haven't even set a date for that yet.
Yeah, our next webinar will be on February 13th.
February
Thursday,
13th.
February 13th,
Yep.
and I'll know what the cattle report is at that time.
And the crop budgets will be done by then. So, okay, very good. Then have a good day.